What do we make of this incredible job market? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial, and in this edition of the Econ Market Minute, I want to share some insights on the shift that's happening in the job market these days. So first, payroll gains are roughly 3 million below trend. The economy added 253,000 payroll jobs in April, higher than expected, and perhaps the last strong report before the economy slides into recession, if indeed that is the case. So last month was revised downward, perhaps a signal that job growth is set to slow in the coming months, and the unemployment rate dipped to 3.4% from 3.5% last month, as more individuals dropped out of the labor force. So remember, individuals have to be actively looking for work to be included in the unemployment rate. So payroll gains were broad-based, especially in healthcare, professional business services, and leisure and hospitality. So despite the very healthy job gains since the reopening of the economy, employment in leisure and hospitality industries are still below pre-pandemic levels by roughly 400,000. So we should expect continued job gains in this industry even if the broader economy shrinks. Despite these strong monthly job numbers that seem to regularly exceed expectations, payrolls are roughly 3 million below trend. This has enormous ramifications on growth the rest of this year and into next. I think this explains a lot of why markets are pricing in a full percentage point cut in rates by next January. And that's the latest expectations even after the strong report for April. Second, participation rates are improving for prime age workers. The employment to population ratio for prime age workers are now above pre-pandemic levels and the highest since mid-2001. This age group is a key contributor to productivity growth in this country. By the way, prime age workers are 25 to 54 years old. So as cost of living is top of mind for many households, we expect more to re-enter the workforce and keep this participation rate moving upward. So third, no signs of the wage price spiral. Over the course of the past year, many were concerned about the wage price spiral. That's when inflation expectations cause workers to demand higher pay and businesses end up increasing prices and so on. However, this was and is not a concern. You can see from the chart I show that wages are starting to moderate a bit, and as labor demand slows, wages will ease even further. So right now, we're probably at a very important inflection point in the economy as economic activity slows from tighter financial conditions. Fourth, small businesses are slowing hiring plans. Looking ahead, a key area for investors to watch includes small business hiring plans. This is a good leading indicator for job growth, and right now, it looks like job growth will slow during the latter half of this year. So what does this mean for you? The latest jobs report will not likely change the expected trajectory for the Fed funds rate. The decline in inflation rates and the uncertainty within the banking sector are major concerns for the Fed right now, and this latest jobs report will not likely change the Fed's current bias toward a wait-and-see perspective at the next meeting. If the Fed indeed is set for a pause, investors will likely experience markets that could return to lower volatility and improved conditions for both bond and equity investors. And we think this could be a likely outcome, notwithstanding some near-term frustrations as the markets deal with uncertainty in the banking sector. Well, that's all for now. Continue to follow me and the LPL research team on social media, and take care.